In 2007, oil prices were surging. A new type of debt instrument was growing rapidly in the shadows of the financial system. Regulators kept saying the fundamentals were strong, and the stock market kept making new highs, right up until it didn't. 1 year later, the global economy collapsed. Now listen to this. In 2026, oil prices are surging. A new type of debt instrument is growing rapidly in the shadows of the financial system. Regulators keep saying the fundamentals are strong, and the stock market keeps making new highs. Bank of America's chief investment strategist wrote to clients in March that asset performance in 2026 is more ominously close to price action seen from mid-2007 to mid-2008 than anything seen since. Goldman Sachs warned that stocks are flashing the same warning signs as before the 2008 financial crisis. Michael Burry, the investor who called the 2008 crash and made $1 billion on it, has sounded the alarm again. Today, we are going to show you exactly what is the same, what is critically different, and what you should actually do with your money based on where the real risk is hiding in 2026. Here is why this comparison keeps gaining traction, and why it deserves to be taken seriously rather than dismissed. Most financial crises do not announce themselves. They build quietly, in the corners of the financial system that receive the least scrutiny, until the pressure becomes impossible to contain. In 2007, the corner nobody was watching closely enough was the subprime mortgage market. Loans made to people who could not realistically repay them, packaged into complex securities, rated investment grade by agencies with conflicts of interest, and sold across the global financial system. When housing prices stopped rising, the entire structure collapsed. In 2026, the corner drawing the most concern is private credit. Private credit is loans made by non-bank financial institutions, private equity firms, asset managers, hedge funds, to companies that bypass the traditional banking system entirely. The private credit market has grown tenfold since 2007. It now totals approximately $2 trillion. The loans carry higher interest rates and lower liquidity than traditional bank lending, and the borrowers are often companies that could not qualify for conventional financing. Jamie Dimon, the CEO of JP Morgan Chase, warned about what he called cockroaches among private credit loans late last year. An IMF director admitted losing sleep over the risks posed by the sector. The shadow banking of 2007 is back, wearing a different name. Here are the 5 specific parallels between 2007 and 2026 that the most credible voices in finance are pointing to. Parallel 1. Oil prices surging from a supply shock. Before the 2008 crisis, oil prices rose sharply, driven then by strong demand from a booming global economy. Today, oil is rising for a different reason. The Iran war has constrained supply through the Strait of Hormuz, but the result is the same. Energy costs rise, inflation stays elevated, central banks face pressure to keep rates high, and higher rates stress the borrowers who are priced for a lower rate world. Parallel 2. Elevated valuations across every asset class simultaneously. Goldman Sachs' chief global equity strategist noted that equity valuations are elevated not just in the US, but in every single region around the world simultaneously. Every major market showing valuations above its own longer-term historical average at the same time is an unusual and historically significant pattern. Parallel 3. A rapidly growing shadow lending sector operating outside traditional regulation. Private credit funds now total $2 trillion, having grown tenfold since 2007. Basel III banking reforms, meant to prevent another crisis, are being diluted or delayed in Europe, Shadow banking liabilities before 2008 surged by roughly 100% of US GDP. Private credit today is about 10% of GDP, smaller but growing faster than regulatory oversight can track. Remember those 4 conditions from the beginning of this video? Oil surging, shadow debt growing, regulators saying fundamentals are strong, markets making new highs? All 4 are present in 2026. All 4 were present in 2007. That alignment is what has even cautious, credentialed economists using the word concerning. Parallel 4. The AI bubble, replacing the housing bubble as the speculative excess of the cycle. Before 2008, housing prices had entered bubble territory, partly fueled by artificially cheap credit. Today, AI stocks have driven some of the most concentrated, fastest rising valuations in market history. Michael Burry has specifically flagged the AI bubble as the trigger most likely to parallel housing's role in the previous crisis. Parallel 5. Central banks facing the same impossible trade-off. In 2007, the Fed began raising rates to cool inflation, which pushed up adjustable mortgage rates and triggered the defaults that brought down the housing market. In 2026, with rates already elevated and inflation above target, the Fed faces the same impossible position: cutting risks, reigniting inflation, holding risks, stressing the private credit market where the most vulnerable borrowers sit. The balanced view is the credible one. Here's the part of this story that the most alarming headlines tend to skip, because the differences matter just as much as the similarities. Difference 1. The regulated banking system is genuinely more resilient. In 2008, the crisis spread so quickly because regulated banks had loaded their balance sheets with toxic mortgage-backed securities. When those assets collapsed, the banks collapsed with them. Post-2008 regulation, higher capital requirements, stress testing, leverage limits, has made the core banking system significantly more robust. Goldman Sachs specifically noted that private sector balance sheets across households, corporations, and banks remain healthy enough to absorb shocks without triggering systemic contagion. Difference 2. Private credit is smaller relative to the economy than subprime was. Shadow banking liabilities before 2008 surged by roughly 100% of US GDP. Private credit today totals about $2 trillion, approximately 10% of GDP. That is still a significant number, but it is not the same systemic scale as the pre-crisis shadow banking complex. Difference 3. Earnings are actually growing. One of the clearest differences between now and 2007 is that corporate earnings have continued to tell a genuinely bullish story. Goldman Sachs acknowledged that global earnings estimates have actually risen since the start of 2026, an unusual and historically positive signal. In 2007, earnings were already rolling over before the crisis arrived. Goldman's own conclusion, despite the warning, is worth stating clearly. They see correction risk as high given current valuations, but expect this to present a buying opportunity with relatively low risk of a more protracted and deep bear market. Not 2008, more likely a correction, painful but temporary, before the underlying earnings story reasserts itself. Jim Rogers' warning that the worst financial crisis of our lifetime will occur in 2026 represents the extreme pessimistic case. It is based on real concerns about post-pandemic debt growth and the AI bubble, but it is the tail risk scenario, not the base case of most credentialed institutional analysts who have reviewed the same data. Here is how to position yourself for a world where correction risk is genuinely elevated, without treating every fluctuation as the beginning of 2008. Move 1. Do not be concentrated in the segments of the market that carry the most bubble-like characteristics. Mega-cap AI and technology stocks, the segment Goldman specifically called elevated relative to historical norms, represent the largest position in most passive S&P 500 index funds. The index is more concentrated in its top 10 holdings than at any point since the early 2000s. This does not mean sell everything. It means make sure you have genuine geographic and sector diversification, not just the illusion of it through a US-only index fund. Move 2. Build or maintain your emergency fund before adding to investment positions right now. If a correction does arrive, corrections in overvalued markets can be sharp and fast. The investors who panic sell are almost always the ones who cannot afford not to, people who need the money within months and have no cash buffer. 6 months of expenses in a high-yield savings account at 4% is the single best protection against being forced to sell at the worst moment. Move 3. Watch private credit exposure in any funds you own. Many target date retirement funds and alternative investment funds now hold significant private credit allocations. If you own funds with names like private debt, direct lending, or alternative income, check what percentage of the fund is in private credit instruments, and whether those instruments have lockup periods that could prevent you from accessing your money during a stress event. Move 4. And this is the one most relevant to the historically documented pattern of investor behavior in volatile markets. Write down your plan for a 20 to 30% market correction, today, before it happens. If Goldman is right that a correction is coming but not a bear market, the investors who benefit from that correction are the ones who were prepared to add to positions during the decline, not sell out of them. That decision needs to be made in advance, in a calm moment, not in real time when headlines are predicting the end of capitalism. 2026 is not 2008. The evidence, fairly assessed, does not support that conclusion. But 2026 has enough of the same fingerprints: oil shocks, shadow lending growth, elevated valuations, a central bank in an impossible position, that treating this as a normal, fully benign environment would be overconfident. The smart position is not fear. It is preparation. Prepared investors do not need to predict the crash. They just need to not be destroyed by one if it arrives.
Here is what the credentialed voices are actually saying. Bank of America says 2026 asset performance is more ominously close to mid-2007 to mid-2008 than anything seen since. Goldman Sachs sees correction risk as high, but expects any decline to be a buying opportunity, not a systemic collapse. Private credit has grown tenfold since 2007 to $2 trillion, smaller than pre-2008 shadow banking, but growing faster than regulatory oversight. Earnings are still rising. Bank balance sheets are stronger than they were. The consumer is in reasonable shape. The honest picture? Real risks worth monitoring, not a guaranteed replay of the worst financial crisis in a century. Your 4 moves. Diversify beyond US megacap concentration. Build your emergency fund before adding to positions. Check private credit exposure in any alternative funds you own. And write your correction plan today, before the headlines make it impossible to think clearly. History does not repeat, but it rhymes. Right now, the rhyme is close enough to pay attention to. If this video helped you understand what is actually similar and what is genuinely different between now and 2008, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money questions with real evidence on both sides, so the fear and the hype both stop making your financial decisions for you.